welcome to Morning Trade with Moneycontrol, brought to you by M-Stock. I'm Sumaira Abdi and I'm here to help you navigate the trading day with actionable trading strategies, sectoral trends, and most importantly, your queries answered live during the course of the show. So keep commenting on our live feed and we'll take it up with our guests. But before we bring our guests on board, let's see what the global handover looks like. Well, equities have corrected on Wall Street as the US 10-year yields have risen above the 3% mark. The Dow Jones Industrial Average dipped nearly 270 points or 0.81%, while the S&P 500 shed over 1% and the Nasdaq Composite slid 0.73%. Investors continued to look for signs of slowing economic growth ahead of May's Consumer Price Index readings slated for Friday. Markets in Asia-Pacific trade mixed ahead of the release of China's trade data for May, which is expected later in the day today. The SGX Nifty, meanwhile, indicates a weakish start for the Indian market. Crude prices have hit a 13-week high. The Brent prices have risen past $123 a barrel as demand has surged in the United States despite record pump prices. Supply concerns and expectations of a demand rebound in China also aid the rise in prices. But let's talk about what's happening back home, and we talk about the stocks in focus as well as the big trend for the market. Hemen Kapadia of Choksey Securities joins in. Hi, Hemen. Good morning. Good to see you in after a long time. You know, for our own market, we have seen that there is this trend of drifting lower. You know, we had these 16,628 levels, which we had seen early on the 2nd of June. And now we are already down to 16,358 on the Nifty. Will this trend downwards continue?
A very good morning to you, Sumaira. Thank you for having me on the show. Yeah, it's great to be doing a show with you again after a long time. See, frankly speaking, Sumaira, we've had not a mad bull run, but a phenomenal move over the last couple of years. Let's say from 7,500 in the Nifty to 18,600. It has mainly been one way with minor corrections. So frankly speaking, we were looking for an excuse to correct. It started with the geopolitical tension with Russia and Ukraine. And now we walked in a correction of a greater degree with crude, inflation, high interest rates, quantitative tightening, everything, the whole gamut. So frankly speaking, the whole year seems to be a washout. It's going to take time to consolidate. Coming back to your main question, is this going to continue? In the near term, probably not too much, but the overall picture is negative. Most of the indices, Sumaira, and even mainline stocks, some of the mechanical indicators on the monthly charts have given crossover sells. So translating into normal language, we've walked into a correction which doesn't seem to be in a mood to get over in a hurry. In the extreme near term, though, I think just below 16,200, there is a little bit of support, but this is a very near term view. A lot of call writing has happened yesterday in 16.3 and 16.4. So I think the pressure today is obvious, but since it's the last day of the weekly settlement, 16,200, maybe 16,150 is where we could take a breather. But yeah, main thing, the sequence of progressively lower tops and bottoms doesn't seem to have ended. Despite saying this, IT and metals are deeply oversold. So notwithstanding near-term permutation combinations, unsustainable bounces around the corner over the next few weeks. Sumaira.
All right, Hemen, we understand your point entirely. So let's talk about some stocks. Now, just yesterday, we have had the Reserve Bank policy where they have hiked the rate by 50 basis points and, you know, not entirely unexpected, right? The governor had already hinted that this is coming. And, you know, I mean, naturally, for banks, this will mean that their margins are going to improve from here on. So technically, which are the banks which look, you know, maybe will continue to trade with strength from here on? Which are the ones to sort of pin your hopes on?
Frankly speaking, Sumaira, the banks have disappointed a bit. I mean, that's very apparent when you see the charts in the bank Nifty performance. But traditionally, I think something like an HDFC Bank, which has come off very sharply, downside appears relatively limited, and the stock seems to be stabilizing. So in case there is a revival in the banking sector, in the bank Nifty, I think HDFC Bank is something which you can sort of have it high on the pecking order. And another bank which is similarly poised or slightly better is Bandhan Bank. I know it's not a mainline bank, so it wouldn't be a favorite for everybody, but a lot of relative strength. Almost 9 months of a sideways movement hasn't yet broken out. So HDFC Bank, near and dear ones, and Bandhan Bank would be the dark horse, Sumera.
All right. Now let's talk about crude because you've highlighted it also as one of the headwinds for the market. Crude prices are now at a 3-week high, and naturally, what it means for oil marketing companies is that perhaps they're going to be under pressure because we're an oil importer. But for something like ONGC, we could see a bit of green. Hemen, anything in this oil and gas space that you like?
Oh, the Chennai Petros and MRPLs have gone through the roof, Sumera. Coming back to ONGC, yes, I think that looks a bit interesting. Like you obviously said, the HPCL and the BPCLs are under pressure, and I don't think that's going away. So ONGC looks to be like a relatively safe bet from a slightly shorter term point of view. Once again, we walked into a correction in ONGC, but yes, in the near term, there is momentum, and even on the longer term charts, it seems to suggest that we still remain safely ensconced in an uptrend. So,
okay. Hemen, we've started getting in some queries from our viewers who are watching this live feed. So first up, Joshua wants to know about DLF and Vedanta. What's your view on both? Could we expect higher levels here?
okay, eight months of a correction as far as DLF is concerned, Sumera. If I take a near-term view, yes, I think the stability. Simply put, its stock seems to be bottoming out on the shorter-term charts. Medium-term, though, there is a lot of support at around 302. If that holds, chances of a bounce back to 350 and 370 seem to be on the cards. I'm not saying it's going to outperform the market, but if the market does give a recovery, DLF will participate. The levels need to be kept in mind. The other stock Sumera you mentioned is Vedanta.
Vedanta, yes.
Once again, I feel that metals, they remain in a downtrend, deeply oversold. Just a hint of a little bit of strength, a sideways movement, a bounce is underway. So once again, near-term view is we are in a range between 295 and 327 or so, Sumera. A bounce in 340, 345 in the next 3 to 4 weeks is possible on Vedanta. If I look at the bigger picture, the stock has moved from 60 to 440 over the last couple of years. Are we not making a new high in the current year, Sumera?
Okay. The next query is on Indiabulls Housing Finance. This is a query sent in by Harry, and he wants to know what's your view on it.
Well, extremely high beta stock. Many times is news-driven, Sumera. Once again, shorter term point of view, we seem to have posted a short-term bottom at 105. Downside appears limited, indicators turning positive. We're at 119.85 right now. A close of a 129 would trigger of a short-term uptrend. Medium term, it's oversold, but there is no follow-up price action. Simply being oversold doesn't mean that we're going to see a bounce back. And if I look at the longer-term charts and the monthly charts, the last 11, 12 months of Sumera, lower top, lower bottoms, that sequence is not yet reversed. So short-term positives, medium-term wishy-washy, longer-term remains weak.
Okay. By the way, the general insurance data for the industry is out, and for the entire industry for the month of May, we have seen a 25% rise in premiums on a year-on-year basis, but compared to the previous month, there has been a drop of nearly 30%. For health insurance as well, there's a 24% rise compared to last year, and on a month-on-month basis, there's a 10% rise. Of the listed universe, it is ICICI Lombard, which looks to have sailed through this month of May very, very well. In this space, Hemen, anything that you like, what you think may be poised for an up move?
Sumera, paradoxically, ICICI Lombard on charts is one of the weakest stocks. Lower top, lower bottom, the stock has posted a 1-year low. So that is strange. Weakness continues. I think if you look at relative strength, I think SBI life insurance is something which stands out in terms of resilience. It doesn't look as if it's going to run away, but if I look at the entire gamut of maybe, like you said, Lombard and ICICI Pru, HDFC Life, what have you, relative strength coming in over there, and followed by HDFC Life Insurance. So SBI Life and HDFC Life Insurance, these are the two stocks which look relatively stable. Once again, I don't expect them to give a tear away move or something. But yeah, compared to the rest of the stocks, they are showing relative strength.
Okay, by the way, this entire cement pack, there's a capex war that's ongoing, and some companies are becoming very, very aggressive. So Rohit Kherkar, I beg your pardon, Gaurang has sent in a question on Ultratech and Ambuja Cement. He wants to know what's your view there.
Well, Ultratech, Sumera looked a bit positive. They announced the capex, and the stock went down like a pack of cards. We're at currently 5531. The lower top, lower bottoms continues. 5250 is a level which looks relatively stable on the weekly charts. Last this level came was in around December 2021. So 5250 is a support. Firstly, we need to wait for this lower top, lower bottom scenario to end, Sumera. Then we maybe anticipate a sideways consolidation and then a recovery. But the sequence of lower top still hasn't stopped. Assumption is that 50 to 50 will provide the necessary respite, but currently it's too late to short, too early to buy. Ambuja is another stock which has shown a lot of relative strength, Sumera. We are moving in a symmetrical triangle on the weekly chart, and we've been consolidating for the last 6 or 7 weeks. So comparing apples and oranges, but Ambuja looks better. In fact, it seems to be in the bull market, at least on the weekly charts, and it looks as if it could close about 380 and go to 400 plus. A lot of difference between Ultratech and Ambuja.
Okay, fair enough. By the way, there's news on Deepak Nitrite this morning. The company has confirmed the news that they have been asked to receive closure notice from the Gujarat government for their Nandesari unit. Now, why this is important is because this is likely to impact their production going forward. Of course, the company says that they will be submitting the necessary applications, documents, etc. And earlier, the management had indicated that they would, could resume production from there in 1 or 2 days. But we'll have to see how, it really moves from here, because this is the plant which is used for the production of basic intermediaries, fine and specialty chemicals. So, it is an important plant. So, near-term negative for sure, but whether or not this is a buying opportunity, Hemen, Vikas Raman has asked that question. Is it a good time to accumulate Deepak Nitrite?
I would wait a bit, Sumera. The market doesn't look as if it's going to run away anywhere. So rather than commit at one go, I think something like an SIP would make sense. From a longer term point of view, once again, stock goes from 200 to 3,000 Sumera over 2 years. So frankly speaking, a year and a half, you can expect it to twiddle its thumbs and do nothing. Obviously, the fundamental reasons are followed. Currently, we're at 1798, rock solid support at 1700. But if that doesn't hold, we could break 1600 in a jiffy. So longer term point of view, stock doesn't look bad. We've had a phenomenal run up, multi-bagger, and now we're paying a price for that in terms of a time and price retracement. So coming back to your question, I would say don't commit at one go. Invest 25% at every fall. Stock is high beta, so maybe keeping in mind 100 rupee fall. So one can look to invest at every 100 or 125 rupees on the downside. But once again, the view for the investor needs to be at least 18 to 24 months, because it's going to take for this thing to unravel, stabilize, bottom out, give a reversal, retrace the rise, and then make a new up move. So this whole thing is going to take time.
Okay. Hemen, do stay on. We have a lot more queries which have been sent to us by our viewers. So we'll come back to you in just a bit for all of them. But for now, let's focus on the consumer impact of the MPC policy, the Reserve Bank's policy, which came yesterday. We have seen a hike coming through for interest rates, 50 basis points. So what does it mean for people like you and me? How will we be affected? Kirtan Shah, founder and CEO of Credence Wealth Advisors, joins in now. Hi, Kirtan. Good morning. One of the most innovative things that we have seen come through in this policy is that now credit cards, you can make UPI payments now through credit cards. What will it mean for consumers? How are they going to benefit?
Hi, Sumera. Thank you so much for having me on the show. Sumera, we've seen how UPI has really taken off in terms of a mode of payment for most of us, right? At least in the tier 1, tier 2 cities, there is hardly anybody who probably is not registered with a UPI payment service, right? Close to 26 odd crore people already registered. I think what we have to understand is the journey of how UPI really played out. So initially they allowed the savings and the current bank account to get linked with the UPI. Then it was a debit card. And now with credit card coming in, I think there are two large advantages. The first one, of course, is unlike you use your credit card at a petrol pump and so on and so forth, where you will be charged MDR, which is the merchant discount rate. As far as I understand, the latest policy said that while you can use your credit card using UPI, you will not be charged an MDR. That's a big plus in my opinion. Second, also there are a lot of people who use credit cards to manage cash flows really well. And those guys have not been using the UPI system because it actually meant that the debit would happen immediately. I think those set of people would also come in the UPI system, in my opinion. Third, very importantly, also what we have to understand here is that there is a small non-clarity, so to say, to start with, is because I'm not sure of whether the merchant will have to bear a cost for a transaction through credit card using UPI. So if the merchant has to bear a cost, then I'm not sure how quickly will this really pick up. So I think there is some clarity awaited there because we are not sure on how the merchant payment system will work here. But if that also goes through in some meaningful way, I think this can really bring in a lot of other people who are on the sideline using credit cards to come and start using the UPI.
Yeah, if the merchant has to bear the cost, we know it'll be passed back to us, right? We've seen that in the past. But Kirtan, don't you think this linking of credit cards to UPI will give rise to, unnecessary spending? Will the credit card behavior of buy now, pay later become even more prevalent?
I think, look, this is very individualistic and, you might very differently behave to the same context that I would do. Right. But somebody who's using a credit card today really has that exposure to use that credit card any and everywhere. I think there are hardly any outlets, barring those smaller retail shops where you probably might not have a POS system to make use of your credit card. So I don't think that this will really lead to unnecessary spending because somebody who holds a credit card today is at the leisure to use it and go on the way that we are discussing right now.
Okay. Now let's talk about the other set of people, those who have home and auto loans or those who are looking to perhaps take a loan. The understanding is that naturally these loans are going to get more expensive now. So Kirtan, what is the advice for both sets of customers, right? Those who already have loans, the existing customers, and those who were looking to take such a loan?
So look, I think somebody who existingly has a loan, I think the pathway is very clear. The rates are going to go up. Now, what we have to understand here is what loans are you linked to? There is something called as an MCLR linked loan, which kind of resets your interest rates every 6 months, right? So even if repo goes up, right, you have a predefined set rate or set date on which the reset will happen. So it is not necessary that repo's gone up twice in the last 1-2 months and your rates have gone up. Your rates will only go up when your reset date, which was originally spoken about, comes into effect. That's one. But if you're linked to something called as the repo rate linked home loan, right, that is where the transmission will happen very quickly. Though RBI tells you that you have, as a bank, you have 3 months to pass that rate on. But what the banks really do is when the rates are going up, the transmission happens immediately, and when the rates are going down, the transmission will take a little time. So if you are somebody who is linked to the repo thing, transmission of higher rates will come to you very quickly versus MCLR. I think two things that you can really do. The first will not make a lot of difference, but you can still make an attempt. If your CIBIL scores are really high, you can look at renegotiating with your current bank, or you can look at refinancing with some other bank. So you can go to some other bank, tell them that my CIBIL is 800, I'm really a good client for you, and why don't you give me the refinancing at a discount rate? Very honestly, it will not make a lot of difference in my opinion, but that's one attempt that you can make. Another very important thing that you should do is leaving tax discussion aside and the advantages that you will get on tax. You will typically now in this cycle look at paying off some loans earlier or ahead of time or prepayment. So if you can make a systematic prepayment of your loans. Of course, that comes with a cost, but that cost is going to be minimal versus what you're going to save when the rates go up. So try and prepay systematically if at all you can, because that will reduce your principal balance and the impact of interest rate hike on your principal will go down. So I think these are two things that existing investors existing home loan borrowers should definitely look at. The newer guys should be very cognizant of the fact that rates are going to go up for another 1.5, 2 years. And they should consider that while taking a loan and not stick to the immediate EMI that the bank is offering. So assume that there is going to be a 5-10% outflow more than the existing EMI that the bank is going to offer to you, and keep that in mind while taking it.
No, naturally. I mean, for existing guys, your recommendation of prepayment makes a lot of sense. And, so prepay your highest cost loan first and go down that ladder. And the thing is that, we're in a now rising rate cycle, right? So perhaps renegotiating could make a difference, because the next policy we might see higher rates still. But, Kirtan, the natural assumption also was that bank FD rates will go up. But I was reading a Twitter thread this morning which suggests that perhaps that is not the case. And also, what about debt funds? Returns were anywhere scarce. Will things become worse for debt fund investors?
So where I think, like I wrote on my Twitter thread as well, typically what happens is the FD rates are predominantly linked to the requirement of the bank, right? Now, in the current situation, we've seen the RBI governor also make this comment multiple times that there is excess liquidity in the system. So if the banks have excess liquidity, there is no need for the banks to typically increase the FD rate. Is because they would want to increase FD rate when they want to attract more deposits. But currently they have enough liquidity. They don't really want to attract a lot of deposits. Also, the existing liquidity that they have, or the more liquidity that they are going to receive has to go through a cycle where this is given out as loans, right? The credit offtake thing that we keep talking about. Now, if you see, there is a credit offtake that has happened, but the credit offtake is largely on retail lending. We've not really seen an aggressive credit offtake happen on the corporate lending side. So unless and until the corporate lending aggressively does not pick up, I think this transmission to FD rates might not happen at the same level at which the loan rates are happening. That's on the FD side. Look, on the debt side, I think it's very clear in my opinion that if you are very unclear of how long do you really want to stay invested in the debt mutual fund space, stay at the lower end of the curve. So stay in liquid, ultra short, low duration money market kind of products, because those are the products which will benefit immediately when the rate increases. Because while the CPCD will get reinvested, I think these products will take advantage of the higher rates existing in the market. But if you're a long-term investor, you have 3-5 years, I think this is a good time to start nibbling on medium duration funds. Try and deploy your investments in 3 or 4 tranches up to December 2022. And I think if you do that over 3 to 4 years, probably you might have caught hold of the best transition in rates versus your investments.
Kirtan, thank you very much. We appreciate your advice. Thanks very much for joining in.
Thank you so much.
Thanks, Kirtan. With that, let's head back to Hemen Kapadia, because he has some stock calls for us. Hemen, what are your hot stocks this morning?
Well, standard disclosure, Sumera, stock trading is injurious to health, especially in markets like these. But yeah, firstly, I have a buy call on General Steel and Power, Sumera. Like I said, the metal theme is deeply oversold. We are trying to play for a bounce. Once again, it's not a rally, but a recovery that we're looking for. So a buy on JSPL at around 370, stop loss of 350, target of 400. This is probably a 10 to 12 or maybe a 2-week call, Sumera. That's a buy call. There is a sell call on Coromandel International. The stock seems to have made a near-term peak. Indicators have given crossover sell. There seems to be a small distribution underway. So one can look for a short-term decline. Short-term, once again, the time frame would be approx 2 weeks. So sell Coromandel International at 930, stop loss 950, target would be 890. So buy on JSPL, a sell on Coromandel International from a 2-week point of view.
Hemen, thanks very much for your advice this morning. And I know we've got a lot of queries coming in from our viewers, but unfortunately, we don't have the time to take them up this morning. May I request you to please log in tomorrow and send in your queries again. For the moment, we'll wrap up on this edition of Morning Trade. Do stay tuned. Markets with Santo and CJ comes up next.